connecting investors, financial institutions, and businesses around the world. Luxembourg is a centre of excellence for global finance. Recognised for its unique international financial expertise, Luxembourg is solution-driven, stable, and open to innovation. A pioneer and global leader in sustainable finance, we help build a better tomorrow today. An international financial centre and a European capital. Luxembourg is an exceptional and welcoming place to work and live. Discover what we can do for you.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Ladies and gentlemen, welcome to this new episode of our Focus On digital series events, where together with our esteemed speakers, panelists, we will delve into this very dynamic realm that is that of international taxation, and dynamic especially in Europe. Today we reflect on the European Union's journey in shaping tax policy, from the introduction of measures like ATAD1 and ATAD2 directives, which stems from the OECD BEPS project, to the most recent tax reforms as implemented in European legislation, such as Pillar 2 and Dac6, but also the pending ATAD3 directive, also known as Shell directive, which is still under discussion and hasn't yet come into force today. So ATAD1 and ATAD2 marked crucial steps in fighting against tax avoidance within the European Union, setting a precedent for common tax rules among member states. Luxembourg rapidly implemented these measures, ensuring legal certainty to the financial sector, and we will have therefore the chance to discuss what is the application experience of these measures emerging from tax practice with our speakers in our tax panel. Now, with ATAD3 and Pillars 2 on the horizon, we anticipate further strides in addressing taxation of digitalization and financial companies who are operating cross-border. And we are honored to have Ms. Manal Corwin, Director of the OECD Center of Tax Policy and Administration, who joins us today to deliver a key message, sharing about the OECD working experience, but also providing an overview of the international tax landscape and future developments. We welcome her today from the United States, so thank for her time. Finally, there will be obviously a dedicated session focused on taxation as a tool to attract talent in the war for talent of today, which has worked very well in certain European jurisdictions so far. So the question is, can taxation act as a driver to attract talent? We will discuss that as well. So let's engage in lively discussions and collective learning as we navigate the complexities of this very interesting field, which is international taxation. Mrs. Corwin, the floor is yours. Thank you very much.
Hello, everyone. It's a privilege to have the opportunity to offer some remarks today about the current and future state of the international tax landscape. Over the last almost 2 decades, we've seen an acceleration in the pace and scale of multilateral cooperation in tax matters, leading to some significant reforms that have reshaped the international tax landscape and produced some concrete results. To understand, I think, the impetus for these large-scale changes and to reflect on the road ahead, I think it's helpful to begin with examining some of the drivers of collaboration in international tax matters. The right to tax is really fundamental to sovereignty and is jealously guarded by national governments. Thus, countries are motivated to collaborate on international tax matters when collective action is necessary to secure or facilitate sovereign domestic policy goals, or the absence of coordination frustrates domestic interests. To this end, some common areas of conversion that we see include closing information gaps that facilitate enforcement, so transparency initiatives, coordinating on international rules and standards, both to avoid double taxation and remove barriers to cross-border growth and investment, but also to protect domestic tax bases, and of course, working together to build and enhance capacity for developing countries. As a platform for collaboration, these areas of convergence and collective interest have really informed the range of work that is covered by the OECD. This includes work on standard setting, such as the Model Treaty, transfer pricing guidelines, and of course, the BEPS reforms. But it also includes work on tax administration, tax certainty, tax transparency, and tax and crime to address illicit financial flows. With this backdrop, let me just provide an update on the areas in which we've seen the most transformational changes emerging from global cooperation over the last decade, beginning with transparency and then turning to the efforts to address base erosion and profit shifting and the digitalization of the economy. Tax transparency is really a stalwart of multilateral efforts to coordinate on tax. These efforts were accelerated in 2009 when the G20 finance ministers endorsed a crackdown on bank secrecy, and the establishment of the OECD hosted Global Forum on Transparency and Exchange of Information for tax purposes. The Global Forum has led the way in implementing the tax transparency standards on exchange of information on request and automatic exchange of information with significant effect. Over 130 billion euro of additional revenues have been assessed or collected since 2009. The work has really been a game changer, effectively ending bank secrecy and achieving great success in the fight against offshore tax evasion. And we continue to build on this work to ensure that, that gains in tax transparency are not eroded by technological developments. So to this end, 48 countries have now already committed to exchanging information under the crypto asset reporting framework by 2027. The second area of impactful cooperation is the project to address base erosion and profit shifting that was launched back in 2013. So again, over a decade ago. The BEPS project was driven by the recognition among governments and taxpayers alike that the international rules and standards for taxation needed to be modernized and adapted to the rapid digitalization and globalization of the economy. Finalized then in 2015, the BEPS project established minimum standards and best practices to align taxation to where value is created and to reduce tax avoidance behaviors and treaty abuses that had evolved over time. As a result of that work, there now have been over 50,000 exchanges of information on 23,000 tax rulings. The multilateral instrument to address tax treaty abuse has now 100 signatories covering 90% of the tax treaties concluded between members of the inclusive framework. And 110 jurisdictions have introduced legislation requiring country-by-country reporting and automatic exchange of information on the cross-border operations of multinationals. Of course, the work of the inclusive framework to implement the BEPS actions culminated in the landmark International Tax Agreement of October 2021 on the two-pillar solution to address the tax challenges of the digitalized economy. Here again, consensus-based coordination has led to tangible outcomes. The 15% global minimum tax went live in January of this year, with now over 35 countries implementing or planning to implement the minimum tax with effect in 2024. South Africa was among the jurisdictions to announce, the latest jurisdictions to announce the introduction of the minimum tax into its budget provisions just this year. So based on current announced plans, we are expecting that about 60% of all in-scope multinational companies will be covered by the global minimum tax in 2024 and over 90% by 2025. Significant progress is also continues on the Pillar 2 subject to tax rule, which enables developing countries to tax intragroup payments subject to low or nominal rates of tax. And again, here, based on current interest in and support for that new rule, we are planning a signing ceremony later this year where we expect significant participation. On Pillar 1, the Inclusive Framework approved the final Amount B report, which establishes or enables low-capacity countries to apply simplified transfer pricing rules. And it was really critically important to, in particular, countries in Africa and Latin America. On Amount A, which is the coordinated reallocation of taxing rights over the revenue of the largest and most profitable multinationals to market jurisdictions, the commitment to finalize the multilateral convention and host a signing ceremony by the end of June remains very, very strong, and we continue to work at pace towards that goal. So those are the many aspects of these work streams that I've just discussed have actually been incorporated into the EU legal framework. A range of EU directives have applied the BEPS actions, including on harmful tax practices and dispute resolution mechanisms. The work on the exchange of information standards has been taken forward at the EU level via the Directive on Administrative Cooperation and its subsequent amendments. And finally, the adoption of the EU directive on the Pillar 2 global minimum tax in December has been instrumental in ensuring the implementation of those rules in a significant number of jurisdictions. So looking ahead, I think the future agenda will be informed by three important themes. Those are inclusivity, stability, growth, and sustainable development. With respect to inclusivity, a critical feature of developments over the last decade is the prioritization of inclusivity. We now have 145 jurisdictions that are participating in the Inclusive Framework on BEPS and 171 jurisdictions participating in the Global Forum. We continue to see interest in both of these forums, and we will continue to prioritize ensuring inclusivity going forward. With respect to stability, as we move into the implementation phase of the two-pillar solution, it's going to be critical that we continue to provide implementation guidance and support to ensure certainty and stability. And this will include, of course, continue to provide capacity building assistance to developing countries who are interested in implementing these provisions. With respect to growth, collaboration on tax policies that foster growth is front and center for many tax administrations. And here we are aware of the very strong interest among countries to collaborate to address global mobility issues associated with post-pandemic remote work trends. In addition, I think there's a strong interest to simplify and rationalize existing rules, to eliminate redundancies, and reflect the existence of the global minimum tax, which will reduce costs for taxpayers and administrations alike. Finally, in terms of sustainable development, there is significant interest in evaluating ways to mobilize domestic resources and finance sustainable development goals. Experts acknowledge that corporate tax alone will not be the answer to meeting today's fiscal challenges, particularly in developing countries. So in addition to corporate tax issues, this could include looking at areas such as the VAT, tax transparency, tax and inequality, tax and crime, the importance of the digitalization of tax administrations, and the effects of tax and informality on the ability to access revenues. In addition to policy considerations and policy design, supporting effective tax administration and continuing to provide capacity building skills is going to be critical going forward. So to conclude, we look forward to building on a strong record of successful collaboration to foster inclusive growth, secure the stability and fairness of the international tax system, and support sustainable development. In this regard, we are very eager to actively engage with stakeholders, including the business community and civil society, to finish the work that we've started, but also to identify and take forward priorities for future work, with particular focus on coordinating with development partners to support domestic resource mobilization in furtherance of achieving sustainable development goals. So with that, thank you very much for your time today, and I look forward to continuing the conversation.
Good morning, ladies and gentlemen, and welcome to this Focus on International Tax event hosted by Luxembourg for Finance. Thank you for having us today. My name is Carbiener. I'm tax partner at Simmons & Simmons, and I'm joined today by two other Luxembourg tax experts, Elisabeth, partner at Elvinger Prussen, and Thierry Lesage, partner at Arendt and Medernach. We will all agree that over the past few years, the international tax landscape has become more and more complex, with many new regulations being implemented. The purpose of this session is to focus on the recent tax reforms and their impact on the broader financial services industry, and especially in Luxembourg. To name a few of these reforms, which are now all familiar to most of us, we can first think about the two anti-tax avoidance directives 1 and 2, commonly referred to in practice as ATAD1 and ATAD2. ATAD1 aims at limiting the deductibility of interest expenses. It has a significant practical impact, especially in the capital market environment, and to a lesser extent also in the funds industry in certain particular cases. ATAD2 is obviously also known to all of us, mainly when it comes to fund structuring. The reason for that is because it may impact the return of the investors, as it may create an additional tax burden at the level of the fund itself, but also potentially at the level of the SPVs sitting below the fund. When we know that Luxembourg is Europe's leading cross-border fund hub, with 5.29 trillion of assets under management in the regulated funds only, we can easily understand the magnitude of such role. So today we will discuss a bit more in details two other significant tax reforms, the first one being Pillar 2, which will be covered today by Thierry, and then Dac6 and ATAD3, which will both be covered by Elisabeth. So Thierry, let's start with Pillar 2. So Thierry, can you let us know what's the purpose of Pillar 2?
Well, as you mentioned, BEPS was about creating a set of measures that are very diversified and far-reaching. More than 10 years ago, BEPS was adopted in order to ensure essentially that multinational companies pay their fair share of tax. It has been successful, certainly to a certain extent, but very quickly it was felt that it did not go far enough. And so the OECD and the G20 came up with two other measures, two pillars. Pillar 1, which is about roughly giving taxing rights to market jurisdictions, so where souls are goods, where consumers effectively acquire services. And Pillar 2 is about ensuring that multinational companies pay an effective tax of at least 15% in all the jurisdictions where they operate.
And what's the status now of the implementation of Pillar 2?
Well, in the EU, the choice was made to have a coordinated implementation. Because of the common market, it was important to have some coordination here. And so there was a directive that was adopted and that was supposed to be implemented by December 31st, 2023. Luxembourg did its maximum. It was very challenging because the deadline was very quick, but it was implemented on time in Luxembourg, whereas in several other member states, Spain, for instance, it has not been implemented yet. And this creates an issue, of course, because it's supposed to be a coordinated approach, but some countries have implemented and some have not. So there are different difficult questions, whether there could be a retroactive implementation which could be challenging vis-à-vis certain constitutional principles in certain countries. But for the situation like it stands now, it's very uncomfortable also for the group, because there are many question marks already raised around the implementation of that.
And what is, in your view, the general impact expected in Luxembourg of Pillar 2?
Generally speaking, from a revenue perspective, there was no forecast. In the bill implementing Pillar 2, the government did not go as far as making forecasts regarding the amount of tax that could be collected in Luxembourg. But the fact is that we have many provisions that are supposed to apply here in Luxembourg, and essentially Pillar 2 is about two sets of rules. First, it's the income inclusion rule that should apply. Income inclusion rule is a sort of super CFC, or controlled foreign company rule. So it's the ultimate parent entity of the multinational group that should collect and pay the top-up tax that is due by all the constituent entities of the group. So the place where the ultimate parent entity is resident will matter from a Pillar 2 perspective. Another rule is the so-called under-taxed profit rule, which will apply in situations where there is no Pillar 2 implementation in the country where the ultimate parent entity is resident. And so the the under-taxed profit rule is applicable in order to allocate to each participating country in Pillar 2 its fair share of tax for the top-up tax that is supposed to be levied on all constituent entities. As we have several ultimate parent entities in Luxembourg, and also intermediate parent entities, as they are called, so it's a situation where the parent entity is resident in a non-participating country, but you have nevertheless the application of the income inclusion rule in a participating country. In Luxembourg, we have many holding companies of US groups, and so these US groups will have an intermediary parent entity in Luxembourg, which means that top-up tax, if any, will be collected payable in Luxembourg. Regarding the impact on Luxembourg constituent entities, there is a priori no big issue, because we have roughly a 25% corporate tax rate in Luxembourg, so which is above the minimum 15% rate. But the fact is that the calculation rules for Pillar 2 are the accounting rules that are applicable based on the consolidated financial statements of the group, whereas Luxembourg tax rules apply based on specific set of rules which may be different. So to take an example, for holding companies, you can have dividends or capital gains that are exempt based on Luxembourg rules and not exempt for Pillar 2 purposes, and vice versa. So you can have certain difficult discrepancies. We also have certain situations that are very complex to manage for groups, because, and that's really my takeaway, I would say, from that situation. We have a huge compliance cost that has to be borne by groups in implementing these reporting and tax filing obligations for Pillar 2 purposes. Whereas, at the end of the day, most multinational groups are already facing an effective tax rate which is well above 15%. So it will be a pure compliance and reporting exercise with no actual tax to pay. And there is, in my view, just a very limited number of groups that will be affected by Pillar 2. And for those groups, so those groups that are using offshore jurisdictions and that are shifting profits to these offshore jurisdictions, I think there were already tools designed in order to tackle these issues. one of the action items of BEPS was country-by-country reporting. So it gives a snapshot of the tax position of a multinational company in all countries. And it's a very precise indicator as to how target transfer pricing audits. And so there was plenty of solutions, plenty of tools at the disposal of tax authorities in order to address these situations without creating another very burdensome set of tools.
And so obviously what matters to all of us as well, what about funds?
Well, for funds, we have a situation where essentially the funds are not the primary target of Pillar 2. The tax neutrality of funds is recognized by the OECD for a long time, of course, and by Pillar 2 as well. So when you have a fund that constitutes the ultimate parent entity of a group, it's an excluded entity, so the fund will remain tax neutral and will not be hit by a top-up tax. That's the principle. There are, as we know, always exceptions. So there are certain situations where a fund could be hit by a top-up tax in a managed account type of situation, for instance. So it's a situation where you have an asset manager creating a fund for one specific institutional investor. And in that situation, the top-up tax may apply to that fund because it will not qualify as a so-called investment entity in the absence of unrelated investor.
Well, okay, that will be then a lot of work still going on in this respect. So thank you very much for super insightful and detailed. Elisabeth, let's move on to your very interesting topics as well. Let's start with ATAD3. Where do we stand now?
Well, you may know the implementation of the directive requires the unanimous consent of all the member states. And I must say I don't know if we will ever manage to get there. ATAD3 initiative has been stuck at draft stage for now more than 2 years. Many compromise texts were submitted on part of the directive's proposal, but member states have not reached an agreement yet on the key aspects of the proposal. This is also true with respect to investment funds, which were originally included excluded from the scope of the directive, and in subsequent proposal or proposed versions they were included. At the end now they seem to be again excluded. There were also discussions about whether the holding structures below the fund should be excluded or not. All that to say that there is no agreement on the directive yet, and that alternatives have been suggested. The first one is a Dac6-like automatic exchange of information, which is based on a number of agreed hallmarks, together with the application of domestic tax consequences where appropriate, and with an exchange of best practices about the use of that information and to apply the consequences among the member states. The second alternative, which has been discussed because the one was not retained either. So the second one is an alternative with a minimum standard approach and a toolbox of consequences. Again, this approach was not agreed.
So based on what you just explained, what is, you believe, the future of the ATAD3 proposal?
Currently, the proposal has not been dropped, but its future remains highly uncertain. We know that Belgium, who has taken over the EU presidency, supports the implementation for the directive, but it does not list the directive among its priorities. Hungary, which will take over after Belgium the EU presidency, announced in February this year that they would put the priority on the competitiveness. So it would not be a surprise if nothing would happen this year, and we could even think whether something will come.
Absolutely. So it looks like ATAD3 will be more like a sort of a Dac6 automatic exchange of information tool. Do you think that imposing additional reporting requirements will be a welcome alternative?
In fact, I will say that the proportionality here will be a key point when it comes to reporting obligations. For example, for Dac6, it was like a mountain which given birth to a mountain at the end. A huge administrative burden, huge costs, and for not only for intermediaries, but also for the taxpayer and even for the tax authorities. And it remains uncertain in its effectiveness due to a lot of unclarities and ambiguities in many of the terms included in the directive.
Absolutely. So you mentioned the proportionality. Is that the same principle that inspired the Court of Justice of the European Union in its 2022 ruling on Dac6?
Yes, indeed. As a reminder, Dac6 provides that all intermediaries involved in potentially tax-aggressive cross-border arrangements are required to report such arrangement to the competent tax authorities. Member states may, however, or they were allowed to waive that obligation, that reporting obligation, for certain intermediaries who are subject to legal professional secrecy. In such circumstances, intermediaries were, however, required to notify to other intermediaries involved in the same reporting arrangement and to the relevant taxpayer when there was no other intermediaries. This being said, the European Court of Justice had to rule on the obligations for lawyers, and they considered that the notification to other intermediaries who are not their client may be in an infringement of Article 7 of the Charter, which protects, in fact, the right for communication between the lawyers and their clients. It was also considered that this was not strictly speaking required to meet the objectives of Dac6. So after this ruling of the European Court of Justice, some countries, like France or Belgium, have already changed their reporting requirements and have recognized the legal professional privilege. Luxembourg also, to a certain extent, the Luxembourg tax authorities have confirmed that lawyers are not obliged to notify to other intermediaries, but to their clients. Now we have the same questions coming again, but for other intermediaries, like accountants, auditors, and so on. And we will see how the European Court of Justice will react.
That's very interesting. Could you please tell us more about that case?
This case, in fact, is a case including 5 questions raised by the Belgium Constitutional Court. This question was raised in September 22 already. And in fact, the Belgium court asked for the compatibility of Dac6 with the EU primary law. The Belgian court asked also whether Dac6 interferes with the right to respect for private life of intermediaries and relevant taxpayers, which is not reasonably justified or proportionate in the objectives pursued by Dac6. Another important question which was raised by the ECG, to the ECG, is whether Dac6 infringes the principle of legality in criminal matters. In that many concepts, including the terms of arrangement, intermediaries, cross-border hallmarks, or the main benefit criterion used to determine the scope of reporting obligations are not sufficiently clear and precise. It remains to see how the ECG will answer, but we know that the Advocate General, Emilian, delivered a few days ago its opinion in that case and concluded in favor of the validity of the Dac6 directive.
And do we have any idea when the court is expected to issue its ruling? Or?
We have no idea, but we would expect, if we are looking at other case law, that they should reply within 2 years. So we may expect that they will reply to this case also this year.
Perfect. And also, regarding investment funds, generally speaking, do you think that Dac6 heavily impacts investment funds?
Also, Dac6, the law does not exclude or provide for an exemption for investment funds. Practically speaking, the impact of Dac6 remains quite limited for investment funds, especially if they are set up as tax-opaque vehicles subject to a product law, RIFE, CIF, and so on. Specific attention should be drawn on the flows between the service providers around the fund, especially if they are part of the same group, because they could then be considered as being associated enterprises. And investment funds may also be impacted, but more on the structures, on the investment structures below the fund.
Absolutely. So thank you so much to the both of you for those detailed and insightful explanations. I also hear that you are both mentioning the additional burden of compliance that we and especially taxpayers have to face. That's obviously a key element to bear in mind. But the least we can say is that Pillar 2 and ATAD3 and Dac6 at least will keep us busy for the coming years and will definitely have an impact in practice going forward. In this respect, there is another matter we didn't per se touch upon today, which is substance. I think over the past few years, we've also seen that substance has become key, absolutely, and that companies have beefed up their substance in Luxembourg. So substance is now actually about being coherent and allocating the resources where they have to be. That's also in line with Pillar 2, what we were just mentioning before. I think that's a direct consequence of all the tax reforms we've seen. Because let's keep in mind that one of the main purposes of all these reforms is always to ensure fairness and equity in the various tax systems and to fortify the tax framework in the face of new and changing business models. So no doubt we'll have a lot to discuss during our next sessions. It was a pleasure to engage in these discussions today with you, and we hope you enjoy the session as much as we did, and we thank you for being with us today.
Hello, Keith, and welcome to our fireside chat.
Hello, Alina. Thank you.
Hello. First of all, I would like to thank our speakers before us and Manal Corwin for giving us an insightful view in the international tax landscape in the financial sector, especially across Europe. I'm happy from our side that we have the chance to exchange on an equally important topic, which is talent attraction, and especially on taxation as a tool for talent attraction internationally. I'm Alina Macovi, tax partner and tax policy lead PwC Luxembourg, and I'm very happy to introduce and welcome Keith O'Donnell, managing partner ATOZ. So Keith, let's dive right in, and I suggest we start with a first topic which is very known in the sector, and which is the competition for attracting the right talent in the right places. So we all know that the sector is more mobile than ever, and obvious one element is technology. But we also see that after COVID, there are different ways of working, new mobility of talent. So my first question would be, how are we seeing other financial sectors addressing this? Have we seen any success stories out of that, and any models which are more successful than others, and any emerging trends?
Sure. So I suppose to start off, we could say that the finance sector is kind of uniquely dematerialized. So that nowadays the delivery of something physical like cash is almost unknown. The other day I tried to cash a check in a bank and they looked at me and they said, we don't deal with these bits of paper anymore. Could you do it in bits and bytes? So we have a very dematerialized sector. That's the first thing. The second thing that's interesting is that where the people sit and how they render services has also changed quite a lot. Within the European market, clearly there are rules about where you have to render services from, but you could say broadly speaking, once you establish somewhere in Europe, you have relative freedom to render services, whether it's insurance, asset management, across border in Europe and beyond. So by essence, we have this industry that's creating quite a mobile workforce. I think it's probably also fair to say that when countries or centres try to attract talent, very often they're doing it to attract talent to serve the international marketplace, so kind of exporting the services, as it were. Because generally, you know, if you're in France, you're not going to try and attract expatriates to serve the French domestic market. So we're talking about the international financial markets here and the financial centres. And what we've seen is that, you know, we're both tax professionals. Originally, we believe tax is very important, so we tend to focus on it. But it's clear that a couple of things came along recently that kind of shuffled the deck in financial services in the various centres in Europe. First was obviously Brexit. And the second then was COVID. Brexit in that there was a movement of centres for regulatory reasons to get critical mass within Europe to be able to render services. And then, of course, COVID came along and gave us all a crash course in remote working. So the two of those have created quite a dynamic marketplace. And finance centres have tried to react to this, to some extent with tax incentives. To some extent, these were countries that had tax incentives anyhow to attract foreign talent. And there's a host of them in Europe, you know, depending on how you count them, you've anywhere between 6 and 10. So we could cite, you know, kind of going from the north to the south, you've got, you know, Sweden has some incentives, certainly the UK has, Ireland has, the Netherlands has. France famously tried to introduce some incentives specifically coming out of Brexit. In Luxembourg, we have an impatriation regime. We've got Spain, the Beckham regime. We've got flat rate tax in Italy. Greece has a regime. So everyone in different ways is trying to attract talent in different ways. And some of them have been successful and less. It's interesting and slightly frustrating. There's very little good empirical data on the effect of these regimes in terms of movement from one country to another. So we tend to rely on more anecdotal evidence by looking at a centre and saying, has it been successful? And I think it's fair to say that over time, the English non-dom regime was successful in attracting talent to the City of London. I think if we look at some of the more recent regimes, it's less obvious, though I do often point to one when people ask me about this and say, does it work? I say, well, it's not European. If you look at what's happening between Florida and New York, for example, there's a clear shift, and some of it is driven by the fact that Florida doesn't have state income taxes. So some centres have had success, though we could say the success has been variable. In some cases, for example, if we look at Portugal, they've quite an attractive regime, but from a financial sector perspective, it hasn't necessarily been, you know, a big attraction. It tends to be people who are doing it for a lifestyle choice as much as a career choice. So the evidence on this is variable, shall we say. Some centres we can see some success, but it hasn't been an across the board, silver bullet to attract talent. I think also it's fair to say that looking at these regimes, politically, countries look at them and tweak them. In the UK, we can see there's a bit of pressure on the non-dom regime politically. We'll see what's going to happen there. We've seen in a couple of other countries, Italy has started tightening up their regime to some extent as well. So they evolve and countries let them evolve over time.
Now, we are both tax professionals and we know how important taxation is in that framework and in the decision making. However, one cannot stop answering, is that enough? Can a tax regime be by itself sufficient in order to attract talent? And really, can it stand by itself? So do you have any insight of that when we look at the European regimes?
Yeah, I think it's never going to be enough on its own, clearly. Tax it's important. People feel it often as much emotionally as they react to with their wallets. But it's clearly not enough, because in the financial sector, there's a very important kind of network effect. If you want to establish somewhere to do business, the human side of it is important in that there's relationships. And often those relationships aren't so much with clients, but also with other professionals in the field. So for example, I was giving the example of Portugal. I don't think it's attracted a nexus of financial services talent in any particular area. Italy has been quite successful, I would say, at attracting individuals. We've seen clients who've moved there because they like the lifestyle, they like the tax regime. But generally, it hasn't been a movement of a team. And in fact, sometimes it creates issues, because if they're more senior people, we start to worry about permanent establishment issues from a tax perspective, or regulatory issues, depending on where exactly they're exercising. So on its own, it hasn't, been a defining factor. I think it's one of a number of things that will mean a country is successful or not in attracting talent to its financial centres.
Now, that was a very interesting view about Europe and how the other financial sectors, and not only, because we've seen US and the distinction between just Florida as a state. Looking closer to home now about Luxembourg. Luxembourg has always been actually successful in attracting talent over the last years. We know the strengths of the financial sector. Now we also know that everybody today is talking about the capability and the challenges which exist out there, like in all the other financial sectors, to attract the right talent. And we also have seen that, for instance, the new government is identifying talent attraction as one of the objectives. How do you think Luxembourg is positioned today in all this environment that we've discussed through in Europe? And we know where the competition is as well, and the other countries developing that.
Yeah, I suppose if you look at it from a macro level, the first thing you could say is that Luxembourg's been a real success story in attracting talent. So over the last 10 years, the population's increased by about 25%, and that's been disproportionately immigration, a factor of 2 to 1, depending on how you count it. So the country is interesting in that sense, in that it's constantly attracting talent. And it's also at a point where, contrary to some other countries, there's no kind of angst around having a lot of foreigners moving to the country. I mean, right now, I think it's around 47% of the resident population is non-Luxembourgish. So it's been, a success in that sense. And we're both examples of that going back many years. So top level, it's been successful. Then if we kind of drill down into it and look at it and some of the factors that make for that success, I think, first of all, there's that kind of very cosmopolitan nature. When people move to Luxembourg, they don't feel like I've landed in a strange country and I'm a foreigner. So the feeling is, it's a cosmopolitan place. We're all, to some extent, foreigners here. Then if you drop it down a level and drill into, what does Luxembourg look like from a tax perspective, which again is kind of the subject of this. And when we're having this discussion, we always start off by saying, well, the starting place in terms of taxes and contributions probably is social security, where Luxembourg is highly favourable. So you get a level of coverage that's world-beating, and the cost is relatively modest, particularly for higher earnings, because you basically stop paying social security contributions at somewhere slightly north of 120,000 on salary. So for high earners, this is quite a good deal compared to some other countries. Then if you look at income tax, I'd say it's moderate. the upper rate certainly isn't low. It's around 45%. But it does take a while before you get up to that. So when we do comparisons, we tend to look at it and say, yeah, it's not the best, but it's moderate. It's not bad either. There is an repatriation regime to help with the cost of attracting talent, and that clearly helps to get over some of those initial costs. We've done regional comparisons recently for teams of financial services professionals coming to Luxembourg. And for example, recently I did one that was comparing the UK, Switzerland, Luxembourg as locations to cite a team of pretty highly skilled people. And what came out of that was interesting. It was basic income tax, salaries, bonuses. There isn't a huge difference. In this case, the executives concerned had stock incentives and carried interest. And that's where there was a clear flip towards Luxembourg, because there the tax differential was very different, because Luxembourg is a very generous capital gains regime, which can work well for stock incentives and carried interest, for example. Then going forward, what I'd say is we've just got a new government since the end of last year. They were elected on a pro-business ticket, and they've already been taking some action. They've extended out some of the lower bands, which has kind of been a net benefit for a very widely spread group of people. They've also said they want Luxembourg to remain competitive while maintaining budgetary discipline. And there, what we tend to say, looking at this when we're talking about Luxembourg's success, is we can look forward with relative confidence because the budget's in fairly good shape by European standards. Debt to GDP is under 30%. The government has said they don't want to splurge, but at the same time they're prepared, to make changes where they're necessary, as long as the funding profile is reasonably good. So I'd say overall we're doing fairly well, from a tax perspective. Looking more broadly, I think the challenge we have is residential accommodation, which seems to be a challenge for pretty much every financial centre. Again, if you work north, Stockholm, if you look at that regime, but if you look at London, Dublin, Amsterdam, Paris. So we're all struggling with the same thing, and there the new government has also introduced some measures quite quickly. So hopefully if we have this in 5 years' time, we won't still be talking about residential accommodation. So yeah, overall I'd say we're doing pretty well, but it's not the sole reason people come here, clearly.
And in this, again, we know how important taxation is, but we just discussed about the other international centers that taxation is not just the only factor. And we are both in conversations with many players that are either expanding significantly their footprint in Luxembourg or just entering the market, and we are talking financial sector. What do you see today as being the drivers of that decision? And when you put into balance taxation and the other drivers? What?
Yeah, so I think when you start this discussion, I think that the first driver is, is there kind of a critical mass of professionals there already, or does the location of a team require that? And in some sectors, clearly there is. At this stage, Luxembourg's reputation as a financial marketplace is well known. I think it's also well known that the financial sector is an important part of the economy. So the government is very protective of it. You don't get this negativity towards the financial sector and seeing the financial sector as kind of a cash cow that you can sometimes get in other countries. I think the critical mass exists in the very traditional areas like banking and asset management in the mutual fund sector. More recently, in certain niche areas of insurance, it's been developing, and I think very strongly also in the alternative investment fund sector, where there's some really world-beating talent here at the moment. So you get that kind of critical mass in sectors, I think, is probably the first thing. The second thing we end up discussing very often is, okay, when we look at the political situation going out, if we're taking a decision to cite a team of people here with a 5 to 10 year plan, what do things look like politically and what's likely to change? And, our governments tend to be all somewhere around the centre. They kind of shift sometimes a little bit more to the right, sometimes a little bit more back to the centre. But they're very stable coalitions, and basically the fringe parties are so small, they're kind of irrelevant. So when we're looking forward, regardless of the combinations of future coalitions, this government's going to run for 5 years. We don't have a concern that at any stage we'll get an extreme on the left or on the right that will disturb the political balance. So that's the next thing people tend to look at, and that's true in tax policy, but also in regulation and other areas. I think our view is also looking forward that focusing specifically on taxation, things are likely to improve more than anything else. We're not expecting negative shocks because the budget's looking fairly healthy. Everyone knows that for the country to thrive, we need to keep attracting talent. So we can look out and we can say with reasonable degree of confidence, things will only get better. The government said they'd like to improve the impatriate regime, for example. There's discussions ongoing of saying, can we improve the taxation of certain forms of stock-based compensation? So the willingness is more to improve as opposed to saying, where do we have to look for money? And that generally is very encouraging when people are looking at Luxembourg as a place to locate.
So thank you so much, Keith, for this. So unfortunately, our time is coming up. So what I'm taking from our discussion is that while we have the positive outlook and we know that on the taxation front it's important and we have the positive outlook into that, I think what we need to take as a conclusion is that it's still the combination of all the factors that are actually guaranteeing today the success of Luxembourg. And this is something that needs to remain, and this is what all the players in the financial sector are looking at. It's not necessarily one measure that outcomes all of that. And so this is what remains in the end the strengths and in a way the objectives also on a going forward basis. So I really think that was interesting for our participants and for our viewers, and thank you so much, Keith.
Thank you, Alina, and thank you all.
Thank you.
Ladies and gentlemen, as we come to an end of this insightful episode, I'd like to express my gratitude to our esteemed speakers, panelists, for the invaluable insights and thought-provoking contributions. Thanks again, Manal Corwin, for connecting from the US, sharing the OECD working experience, providing her insights, and also the future objectives of the organization. Lastly, I would also like to extend a heartfelt thank you to our sponsors, for the generous support without which this event would have not taken place. So thank you once again, and looking forward to see you in our future episode. Thank you.